Alphabet just announced they're massively ramping up AI infrastructure spending, and tech stocks had their worst week in months. Hi, everybody. I'm Christos, co-founder of Caplytica. Today, I'm walking you through three critical stories: the tech sector sell-off, anxiety around the delayed January jobs report, and a quiet rotation from growth to defensive stocks leading the markets. And there's one detail that's buried in the spending announcement that almost nobody is talking about, but it completely changes how you should think about tech valuations when CapEx spikes this dramatically. I'll break it down. Let's get into it. For years now, investors celebrated every single AI spending announcement from big tech. More data centers, more chips, more compute capacity. It all signaled that these companies were winning the AI race. Then Alphabet reported earnings last week, beat profit expectations, and the stock got hammered anyway. Here's the number that spooked everyone. Free cash flow is about to take a significant hit as capital expenditure surges into the billions for AI data centers, chips, and infrastructure. The market isn't worried about Google's current profitability. It's worried about whether these companies can sustain this level of spending without destroying shareholder value. We're talking about an arms race where the price of admission keeps rising, and nobody knows when or if the payoff materializes. This matters for your portfolio if you own any of the major tech stocks. The question isn't whether they're dominant companies, because they clearly are. The question is whether today's earnings and cash generation will be sacrificed for tomorrow's competitive advantage, and whether or not that trade-off is actually worth it. The January jobs report should have been released last Friday. Instead, it got delayed by a brief government shutdown and won't drop until February 11th. That delay created a vacuum of information at exactly the wrong time, when investors are already anxious about labor market trends. Here's why this matters more than just another economic release. The labor market is the foundation of consumer spending, which drives roughly 70% of U.S. economic activity. Several reports this week highlighted that 2025's job market was already showing signs of weakness, and jobless claims came in higher than expected during the week. Markets do not like uncertainty, and the combination of delayed data plus signs of softening employment has investors on edge. A weakening job market often precedes broader economic slowdowns, which means employment data is one of the best forward-looking indicators for recession risk. Strong job growth typically supports stock prices because it signals economic health. Weakening employment, on the other hand, often foreshadows market downturns because it threatens the earnings growth that justifies current valuations. The heightened anxiety around this particular report isn't just about 1 month of data. It's about the pattern. If 2025 already showed labor market weakness and January comes in soft, it suggests that the trend is accelerating. The Federal Reserve watches employment data closely when setting interest rate policy. A weakening labor market could force their hand on cuts, but it would also signal economic fragility that might offset any benefits we could get from lower rates. Why would the market drop the day after hitting a historic milestone? That's exactly what happened this last week. The Dow crossed 50,000 for the first time, futures immediately turned lower, and investors barely acknowledged the achievement before shifting focus to economic data. The disconnect tells you something important about where we are in this cycle. What made this week interesting wasn't the milestone itself. It was the divergence. Industrial and financial stocks drove the Dow higher while technology lagged significantly. That kind of sector rotation doesn't happen randomly. It suggests money is flowing from growth-oriented names into more traditional value sectors. For context, the iShares software ETF had its worst single-day decline since April, while the Dow was celebrating new highs. This matters because the composition of your returns depends heavily on what you actually own. Broad market index funds give you exposure to everything. But if you're concentrated in tech, your experience last week looked nothing like that 50,000 headline suggested. The pattern running through all of this is the same. The headlines say one thing and the data says something else. The Dow hits 50,000 while tech bleeds. Companies beat earnings while shares fall. The labor market looks stable while weakness slowly builds underneath. If you want to dig deeper into how the Fed leadership transition could reshape rate policy and what that means for different asset classes, we covered Kevin Warsh's background and policy philosophy in detail recently. That context matters more now than it did 2 weeks ago. The jobs data lands Wednesday. That's when we'll know whether the market's caution was justified or whether this week's rotation was just noise.